Welcome back, everyone, to part 5 of my Tesla 4Q 2024 estimates deep dive. Now we dive into energy and storage gross margin. My bottom-up calculations suggest that energy margin will decrease from a record 30.5% in 3Q to 28.0% in 4Q. The CFO warned on this 3Q earnings call that this very high margin was the result of, and let me just read it. This is a function of mix of projects being deployed in the quarter. I think this was his way of saying there were some positive one-off effects that came to bear in this quarter, and then he also points out that there will be fluctuation in margins as we manage through deployments in our inventory, and I believe this is he's basically signaling that margins will contract. I did some bottom-up calculations, and perhaps I will be too optimistic, but the implied margin that my modeling suggests is around 28%. So this would imply obviously a sequential decrease of the margin by 2.5%, but still a substantial increase compared to the year earlier, where the margin was 21.8%. The primary reason for this is, I put down here some comments. There's some competition, as I touched on earlier, that can offer megapacks at a kilowatt price of even below $100 from China. But the kilowatt price is not not in all projects the key driver. There are also other factors important, because Tesla not only provides the hardware, Tesla also provides the important software to run these systems effectively. And then obviously Tesla is the biggest installer of such systems. They have the most amount of experience, etc. And then there are also some political issues. There are certain kinds of buyers who will not buy these products from a Chinese supplier for all kinds of political reasons I'm not going to get into. And for this reason, and for reasons I explained earlier, I think this margin is likely maintainable, if this is a word, in 4Q. Then we move on to GAAP gross margin. GAAP stands for Generally Accepted Accounting Principles. It's just a shorthand to refer to US GAAP in most cases. And here we just take the reported gross profit, total gross profit divided by total revenue. This gives us the gross profit number. And just real quick, little recap why gross profit margin is so important. The moment you have, let's say you have a business that's still loss-making on a bottom line basis. Bottom line basis means on a net income basis or operating profit basis. And the key takeaway from gross profitability is that if you can just scale your business enough, at some point you can get to bottom line profitability. But as long as you're still gross margin negative, there's no amount of scaling you can do. And there are some exceptions I'm not going to get into, that will make the business profitable. So that's why it's a key metric investors look at. However, of course, the savvy analyst looks at this in more detail, because gross margin isn't gross margin. There are different kinds, and because in the gross margin there's also a fixed cost element. So even if you have a slightly negative gross margin principle, if you scale enough, you can grow your gross margin into positivity, and hence you can become bottom line profitable. But this is more a detailed financial point. So the big picture is you of course want to be gross margin profitable, and the higher the gross margin, the less scale you need to cover a larger fixed cost base, and the fixed cost base would be your R&D and also your SG&A, which are these items here. So that's why it gets a lot of attention by investors. For example, if you have very low gross margin, incremental revenue growth isn't really adding many bottom line dollars in earnings. This is kind of the big picture view of gross margin. So this is important to keep in mind. Gross margin is far from bottom line profitability, because oftentimes in comments I get, I can see that people do not really understand that even if you're gross profitable, it doesn't mean not even close that you anywhere close to total profitability, and only total profitability matters, and not gross profitability. So and here you can see I forecast a decrease in profitability, and again, this is not something I hot plug or something. This is basically falls out of the model if you run all the calculations, all the assumptions that we discussed previously. So there's an output of the model. So instead of the way we go into OPEX, OPEX is operating expenses, and operating expenses comprise R&D, so research and development, selling, general, and administrative expenses, and then also Tesla includes restructuring charges and other items. So restructuring charges is sometimes not included in OPEX, but this depends on management discretion. Tesla in general is very is not trying to make their numbers look better in any way, really. For example, Tesla um, excludes very few items, makes very few adjustments. For example, if you look at General Motors has always a huge number of adjustments, and when you actually plot, and I've shown this to my subscribers, if you plot the delta between the reported net income and the adjusted net income that adjusts for all the one-time items from GM's perspective, there's a consistently every quarter a huge delta. So the adjusted number never really the reported number never really is close to the adjusted number, so which is kind of pointless. But we're not talking about GM in this video series, so let's look at Tesla's R&D expenses. And in 3Q something quite interesting happened. R&D expenses actually decreased. And it's interesting because we know Tesla is working on various products. Tesla is constantly expanding their global FSD effort. We have seen news from out of various countries. Tesla is hiring test drivers for FSD. This is only one small part. There's obviously the Cybercab development. The launch slated for 2026. The new lower cost vehicles that come online probably in the next few months. Then there's the highly anticipated refresh of the Model Y, and you would expect this would incur more R&D expense, but obviously in Tesla's case, as I always like to say, Tesla is a lean, mean machine, and it's true. They lowered the R&D expenses. But again, I try to be slightly conservative. I do expect there will be a sequential increase in the fourth quarter, just because Model Y refresh is nearing launch, and typically just prior to launch, you tend to see the highest R&D expense. And we have an example here in this time series. So Cybertruck launched end of November 2003. And then in the quarter before, we had peak R&D expense. And if you remember this period, so this is from early July to end of September, there were tons of Cybertruck sightings, tons of test mules driving around, and like globally, they're on cold climates and hot climates doing all kinds of testing. This incurs a lot of cost, and then there's obviously other R&D projects going on. So you saw here a spike. So that's why I think we will also see a sequential increase in 4Q. This is why I forecast a slight increase. Here sequentially, I expect 5% increase. So, and then when we move on to SG&A expenses, so again, this is selling, general, and administrative expenses, and this includes and I list the key items here. It comprises personnel expenses. There's a significant component of share-based compensation in that item. Facility costs, the costs of the showrooms, marketing costs, executive compensation, the finance function, the human resources function, IT, legal, professional services, and contract management, litigation settlements. All this stuff is included in this line item. And you might remember Tesla made the by far largest restructuring in its history in 2Q. There was roughly 10,000 personnel headcount reduction. And this was to restore Tesla's historic efficiency, and we look at this in a second. And I'd like to remind everyone about the comments the CFO made. So the CFO said in 2Q that this headcount reduction would which was around 10% of global staff, Tesla expects to generate well in excess of 1 billion on an annual run rate basis. So basically, annual means 4 quarters. So roughly speaking, he expects at least 250 million savings per quarter, and we actually see, I think, some effect of that in 3Q. because we had this significant sequential decrease of first of all, we saw some effects in 2Q because some of the cost of the headcount or most of the cost of the headcount reduction was put into the separate item restructuring and other we touch upon later. So you see already some savings here, and then more savings here, but there was still some restructuring charge as we see later. But again, this is not included here. There's already kind of a clean number. So because of the CFO's commentary, I expect SG&A to remain largely flat. There is potentially even some upside risk here, that the that Tesla actually might deliver even more cost savings. But I didn't want to be too sort of bullish on this item, and that's why I focused roughly flat SG&A spend. And a big other reason also was for this assumption that volume has increased quite materially, and there is some and not only volume in vehicle sales, but also energy sales. So overall, the scale of the business is growing, and there's a strong correlation between the size of the business and this line item. It's certainly not perfect. SG&A should grow much slower than the total size of the business. And when I speak about total size of the business, I'm talking about total revenues. So this is something to consider. So overall, flattish development for these reasons. And then when we move on to what I meant before by Tesla did the headcount reduction to restore its historic efficiency. This is what I mean. So here you look at the SG&A spending divided by total revenue, and you can see that in prior quarters, so in 2022, 2023, this number went below 5%, and then slowly crept up. And this, of course, was in part driven by inflation. People got raises, etc. In services, cost of services went up, etc. So there was a big kind of inflation driver, and then just Tesla's organization, by Tesla standards, got a little chubby, and then Tesla started a diet in 2Q, like a crash diet. As you can see, the ratio dropped quite a bit, and you can see it kept dropping quite quickly by 30 bips Q on Q from 2Q to 3Q, and even though I expect like slightly increasing sequential SG&A, as you saw in the prior slide, because the total revenue is growing, you can see that the efficiency ratio is improving further. And this efficiency ratio, this SG&A ratio, you want it to be as small as possible. And this is also an interesting sort of long-term aspect to Tesla. Tesla grows, but keeps its cost base quite well in check. Unfortunately, I'm not showing more years sort of back, because you would see how massively this has come down. But Tesla has always been quite efficient for its scale, etc., and especially for an automaker. And next, when we look at the last OPEX, operating expense item, which is the restructuring and other item, you can see quite often there is nothing to report for Tesla, so that's why it's zero in all these quarters. I expect it to be zero in 4Q. Tesla recognized an all-time high restructuring charge of 622 million, so it was a very high one-time negative item. This affects significantly unadjusted EPS numbers. So that's why if you look at unadjusted 2023 earnings numbers and 2024 earnings numbers, they look not very much different. And this is a key driver, but you have to strip these out if you want to do sort of any kind of valuation work. Then there was a 55 million additional restructuring charge, which was still related to the 2Q restructuring, and the CFO talked about this in the 3Q call. And my understanding is this is now done, and that's why I forecast no restructuring charges in 4Q. And there shouldn't be any other material items. At least right now, we have no indication of such items. So on this slide, we then basically add everything together. We add research and development expenses. As I said earlier, I expect a slight increase. SG&A expenses pretty much flat. I don't expect any restructuring charges. So if you add everything together, you see that the OPEX base remains basically flat. There's a 0.3% increase, and that increase is driven by the R&D expense increase that I expect, but again, I could be off on that one. And then what is helpful is that this 55 million, um, we are, I mean, according to Tesla, it's unlikely we have restructuring charges. Also, I have not read anywhere additional sort of headcount reductions outside of the normal sort of attrition of a company. So this looks quite good for Q. Then on this slide, we look at the, so what does this mean in terms of margin, and commonly used margin by investors is operating margin, to see just how much, after you paid all the bills, how much is actually left over before you pay for the debt you raised to finance the business, the interest expense. This is comes after operating expenses, as you can see here, or the interest income you earn. The reason why you exclude interest income from operating income is because Tesla is a car company, is an energy company, is a software company, is an artificial intelligence company. Earning interest on cash is not part of Tesla's business model. That's why you show this outside operating income. If Tesla was a bank, of course, this would be part of the operating business, but it is not, and that's why it's the correct way of showing it as Tesla does it. And then you have interest expenses on basic debt Tesla has on the balance sheet, or I should call it interest-bearing liabilities. It's the more accurate term, really. And then you have other expenses. Other expenses is everything that that is not linked to your business purpose, but happens to your business. For example, in Tesla, the main other recurring item here is the foreign exchange effect on intercompany balances. But I will talk about this later when we get to this point. So if we now look at this margin, and here I show the margin excluding restructuring charges, it's important because restructuring charges, as you saw on this slide, this is a non-recurring item. So you want to always look at this and excluding restructuring charges. And here I marked the components that you need to calculate the margin. You take operating profit, you add back restructuring charges, and then you divide everything by total revenue. And this is the margin you get. And you can see that the model, based on all the assumptions that we discussed, implies a 10.2% operating margin. So there's like a 0.8 percentage points decrease sequentially. So just to recap, key drivers are low ASP, that could not be fully compensated by the strong energies business. And but I will not recap everything that we discussed already. So if you listen to the other videos, you know by now in detail why it has come down. But over here, and by the way, I'm sorry, here I have a little, this is a stale bullet point. This is wrong, just to point it out, so ignore it, please. These are the correct numbers because they're all linked up with the modeling. And so long story short, with over 10% operating margin, this is still a very good number. So especially in the current global automotive climate, automotive is still by far the biggest business segments of Tesla. And I analyzed the global auto industry intensively. The vast majority of auto companies would kill to get like this operating margin right now. So keep that in mind. It's a very strong number. So next we get into the non-operating items, and they're actually quite important for this quarter. But this video is already quite long, so I stop this part 5 here now, and I see you in part 6. See you later.